I hope that the war in Iran would not be an issue in this espresso for the time being, but things have changed. Since the end of June, we have renewed escalation and military action taking place in the Middle East. And we see that not just the Strait of Hormuz, but also another very important traffic route, namely the Red Sea, might be or is already disrupted by the war in Iran. The markets so far have been relatively calm regarding this news. But thinking about physical shortages, things might change pretty quickly. After the first wave of the war, where we have seen a substantial reduction in the storage capacities, both of oil and of gas around the world, those storage capacities are pretty reduced. And therefore, we get quite early to a stage where we might have this point of physical shortages. And the closer we get to this, the more likely it is that we see a surge in prices for raw materials. And that's not just oil and gas, but also other very important raw materials, what we need for production processes around the world. We might also get, because of this disruption of supply chains, we might get some fears about a substantial economic downturn. So that could cause some havoc on financial markets. We also have central banks which look through this inflationary pressure in the first wave on a large extent. Now, with the second wave being there, it is now not just likely, but in our view, most likely that we will see rate hikes both by the ECB and the Fed in September. So we changed our view there. The question is, how long does this war and this closure of this very important traffic routes continue? And we think that getting closer to winter, the pressure on both parties in the war, namely Iran and the US, is likely to increase. None of the large countries really can go into the winter with very reduced capacities on oil and gas. Nobody wants to freeze. Therefore, we think that particularly on Iran, there might be more pressure from a big demand country, namely China, coming in to end this action. And on the US side, markets are likely to play a role, and therefore the pressure on the US administration is likely to increase significantly to find some kind of solution. So we think that by the autumn, we will have some kind of solution, what would open then at least the Strait of Hormuz and getting to some kind of normalization. So it is still, in our view, a temporary event and not a lasting one. Therefore, looking into 2027, at the beginning we probably will get some kind of recovery taking place. But in the course of the year, we are likely to see more signals that the AI-related investment boom is likely to come to an end. So we see a dip in AI investment because the expectations of returns of these investments are not likely to be met. We, in our long-term forecast, therefore, have a correction built in from the second half of 27 until the year 28. And this will be both visible in the economic development and also in market developments, where we in both cases see a dip in developments coming through. In this environment, central banks, so both ECB and Fed, are likely to reverse their interest rate hikes from 26. So the ECB is likely to cut 2 times next year, bringing rates down to 2% again on the deposit rate side. And the Fed is likely to start with rate cuts in March or spring next year. And we expect in total 4 rate cuts, bringing the Fed fund rate down to a range of 2.75 to 3% by the year end 27. Looking through the next couple of years, we expect then a kind of recovery from 28 or 29 onwards. In the case of Germany, nevertheless, we have revised down our forecast for this late period of the next years somewhat. And this is because of the delayed implementation of reforms. We have now lost 1 year of the government, what promised some reforms last year, and therefore what did not take place so far can't have any positive implications on the German economic development in the future. And although we see now the start of reforms, it is probably still too little and too late. So therefore, we have revised down our forecast for the years 28 to 2031 and only expect on average growth rates between 0.5 and 0.75%. So 0.5% to 0.75%, that's it, what Germany can deliver. And therefore, we need more action to come through, but we're still kind of optimistic that this will happen. Otherwise, we would have to revise down our forecast in the medium term for Germany and probably large parts of Europe again.